Congress just handed seniors a brand new tax deduction worth up to $6,000, $12,000 for married couples. Headlines are calling it a game changer. But when we ran the numbers, we found something nobody's talking about. Fewer than half of Americans 65 and older will actually benefit. The poorest seniors get nothing, the richest are phased out, and that claim that it reduces your Medicare premiums, it's flat out wrong. Let's break down exactly what this deduction is worth, who it actually helps, and the critical detail almost every article gets wrong. Here's the question we're answering today. How much money does the new OBBBA senior deduction actually put back in your pocket at every income level? And does it really help with Social Security taxes and Medicare surcharges like so many people are claiming? The One Big Beautiful Bill Act created a new deduction specifically for taxpayers aged 65 and older. Up to $6,000 for single filers, up to $12,000 for married couples filing jointly where both spouses are 65 plus. It's available for tax years 2025 through 2028, so this is a 4-year window, not a permanent change. We pulled the actual IRS Schedule 1A instructions, the Joint Committee on Taxation Distributional Analysis, the current IRMAA bracket tables from CMS, and the Social Security taxation thresholds. We built a model that calculates the real dollar benefit at every income level from $30,000 to $300,000, and what the data shows might surprise you. Let's start with the basics because getting this right matters. For 2025, a single filer 65 or older already gets a standard deduction of $15,700. That's the base standard deduction of $14,600 plus the $1,100 age add-on. The OBBBA adds a new bonus on top of that, up to $4,000 for single filers in the first year, scaling up to $6,000 by 2028. For married filing jointly with both spouses 65 plus, you get double, up to $8,000 scaling to $12,000. So by 2028, a married couple where both are 65 or older could deduct a total of $46,700. That's the base standard deduction of $29,200, plus the age add-on for two of $5,500, plus the new OBBBA bonus of $12,000. That's your triple stack, and it's a genuinely large number. But here's where it gets interesting. This deduction has income phaseouts. For single filers, the phaseout starts at $75,000 of adjusted gross income and ends at $150,000. For married filing jointly, it starts at $150,000 and ends at $250,000. Within that range, the deduction shrinks linearly until it disappears entirely. So if you're a single filer making $100,000, right in the middle of that phase-out, you only get half the deduction. At $125,000, you get a quarter. At $150,000 and above, you get zero. Now here's the critical detail that changes everything about this deduction, and the part almost every headline gets wrong. If you've seen coverage of this deduction, you've probably read that it's above the line. That would mean it reduces your adjusted gross income, your AGI. And that would be a very big deal, because AGI is the number that determines your Social Security taxation, your Medicare IRMAA surcharges, your ACA premium credits, basically every means-tested threshold in the tax code. But it's not above the line. We pulled the actual IRS Schedule 1A. The OBBBA senior deduction is below the line. It reduces your taxable income, not your AGI. Why does that matter? Let's walk through 3 specific examples. First, Social Security taxation. Whether your Social Security benefits get taxed and how much depends on your combined income, which is based on AGI. The thresholds are $25,000 for single filers and $32,000 for couples. Since this deduction doesn't touch AGI, it changes absolutely nothing about how your Social Security is taxed. Zero impact. Second, Medicare IRMAA. The income-related monthly adjustment amount, the surcharge that higher-income retirees pay on Medicare Parts B and D, is determined by your modified adjusted gross income from 2 years prior. The first IRMAA threshold kicks in at $106,000 for single filers and $212,000 for couples. Again, since this deduction is below the line, it doesn't reduce your MAGI. It provides zero IRMAA relief. Third, ACA premium credits. If you're between 60 and 65 and buying insurance on the marketplace, premium credits are calculated from, you guessed it, AGI. no AGI reduction, no premium help. So every article claiming this deduction helps with Medicare surcharges or Social Security taxes is simply wrong. It only reduces the income that's subject to federal income tax rates. Now let's look at the distributional data, because this is where the math gets really revealing. We modeled the actual tax savings at different income levels for a single filer 65 or older, using the full $6,000 deduction available by 2028. At $30,000 of income, primarily Social Security, the deduction is worth nothing. Zero. Why? Because between the standard deduction and the age add-on, this taxpayer's taxable income is already at or near zero. You can't deduct your way below zero. There's no tax to reduce. At $50,000, the picture starts to change. This filer has some taxable income, so the deduction saves them about $660. That's the $6,000 deduction times the 10% bracket they're sitting in. Not bad, but not life-changing. At $75,000, right at the phase-out threshold, the full deduction applies. At a 12% bracket, that's $720 in savings. This is roughly the sweet spot for maximum benefit. At $100,000, the phase-out has already cut the deduction in half. You're getting $3,000 of deduction instead of $6,000. But you're in the 22% bracket now, so the savings are about $660. At $150,000 and above, the deduction is completely phased out, zero benefit. So according to the Joint Committee on Taxation Distributional Analysis, roughly 77% of the benefits flow to middle and upper middle income seniors, those earning between $50,000 and $150,000. The bottom tier gets almost nothing because they don't owe tax. The top tier gets nothing because of phase-outs. This is a deduction that primarily helps the middle, which, depending on your perspective, is either well-targeted or a missed opportunity to help the most financially vulnerable seniors. And here's one more wrinkle that nobody talks about. The phase-out itself acts as a hidden tax. Within the phase-out range, every additional dollar of income doesn't just get taxed at your marginal rate, it also reduces your deduction. For single filers, the phase-out adds roughly 1.3 to 2.6 percentage points to your effective marginal tax rate between $75,000 and $150,000. For couples, the same bump hits between $150,000 and $250,000. It's not enormous, but it's real, and it's invisible to most people. But here's where it gets interesting for anyone doing retirement tax planning. Because this deduction sunsets after 2028, it creates a temporary 4-year window where you effectively have extra room in your tax brackets, and that means a Roth conversion opportunity. Here's how it works. Say you're a married couple, both 65, with $120,000 in income, well below the phase-out. You get the full $12,000 bonus deduction. That means $12,000 of your income that would have been taxed is now sheltered. You could convert an additional $12,000 from your traditional IRA to a Roth IRA, pay the same total tax you would have owed without the deduction, and permanently move that money into a tax-free account. Over 4 years, that's potentially $48,000 converted to Roth at no additional tax cost. At a 7% annual return over 15 years, that $48,000 grows to over $132,000, all tax-free. Now this strategy only works if you're below the phase-out thresholds, and it requires that you actually have traditional IRA or 401k balances to convert. But for the right household, it's a genuinely valuable planning move that leverages this temporary deduction into a permanent tax benefit. The key insight is that this deduction is temporary, it expires. So the smart play isn't just to enjoy slightly lower taxes for 4 years, it's to use that breathing room strategically. Alright, let's bring this all together into a framework you can actually use. We built a decision tree based on 3 variables: your age, your income, and your filing status. First, are you 65 or older? If not, this deduction doesn't apply to you, full stop. Second, what's your adjusted gross income? If you're single and under $75,000 or married filing jointly and under $150,000, you get the full deduction. If you're in the phase-out range, you get a partial deduction. If you're above $150,000 single or $250,000 married, you get nothing. Third, do you actually owe federal income tax? If your standard deduction plus age add-on already wipes out your taxable income, this this extra deduction has no effect. It can't make your tax bill go negative. Here's the bottom line. If you're a senior with income between roughly $50,000 and $150,000 as a single filer, or $100,000 and $250,000 as a couple, this deduction saves you somewhere between $400 and $750 per year. That is real money, but it's not the thousands of dollars the headlines imply, and it does absolutely nothing for your Medicare premiums or Social Security taxation. The biggest misconception out there right now is that this is equivalent to no tax on Social Security. It is not. It's a below-the-line deduction that reduces your taxable income. That's it. If someone tells you this deduction will lower your IRMAA surcharges, they either haven't read the legislation or they don't understand the difference between AGI and taxable income. And the smartest move for eligible seniors: don't just pocket the tax savings. Use the 4-year window to do strategic Roth conversions while the extra deduction room exists. That turns a temporary tax break into a permanent advantage. If this breakdown helped you understand how the new senior deduction actually works, hit that like button. It helps more people find this analysis. And if you want more videos where we do the math on the financial decisions that matter most, subscribe to Math and Money. We'll see you in the next one. And the smartest move for eligible seniors: don't just pocket the tax savings. Use the 4-year window to do strategic Roth conversions while the extra deduction room exists. That turns a temporary tax break into a permanent advantage. If this breakdown helped you understand how the new senior deduction actually works, hit that like button. It helps more people find this analysis. And if you want more videos where we do the math on the financial decisions that matter most, subscribe to Math and Money. We'll see you in the next one.